What if you invested just $1 in Bitcoin every single day for 10 years straight? No lump sum, no timing the market, just $1 a day, rain or shine. Sounds tiny, right? That's the whole point of this experiment. But Bitcoin doesn't move in a straight line. It swings wildly, up and down. So what actually happens when you feed a small, steady dollar into that chaos every day? For a decade. We're going to walk through this, year by year, and watch the number grow, shrink, and grow again. This isn't about predicting the future. It's about understanding how small, consistent habits behave inside volatility. By the end, you'll understand a strategy called dollar cost averaging, and why so many investors swear by it. Stick around, because the middle of this video might genuinely surprise you. Let's start with the basics. What are we actually buying, and why $1 a day? Bitcoin is a digital currency that isn't controlled by any single bank or government. Its supply is limited, its price is set purely by buyers and sellers, and that makes it extremely volatile. That volatility is exactly why most people are scared to invest a large sum all at once. That's where dollar cost averaging, or DCA, comes in. You invest a fixed small amount on a regular schedule. Instead of guessing the perfect moment to buy, you buy a little bit constantly, no matter what the price is doing. Some days your dollar buys more Bitcoin because the price is low. Other days your dollar buys less because the price has climbed higher. Over time, those highs and lows average out, which is exactly why the strategy is named what it is. So here's the setup for our 10-year journey. $1 every day. No exceptions, no skip days. Let's take that first step into year one. Year one begins calmly. The price is low, so every dollar stretches further. Each daily dollar buys a decent chunk of Bitcoin while the market stays quiet. Then, without warning, the price jumps sharply upward. The jar of coins you've built so far is suddenly worth noticeably more than what you put in. It's tempting to feel like a genius right now. But year one is only the beginning. Near the end of the year, the price pulls back sharply, and the jar's value dips. But here's the key part. You keep dropping in your dollar anyway, dip or no dip. That dip actually means your dollar is now buying a slightly bigger slice of Bitcoin again. By the close of year one, the jar holds more Bitcoin than the raw dollar total might suggest. 1 year down, 9 more to go, and the swings are about to get bigger. Year two opens with excitement in the air. Prices are climbing fast, and everyone's talking about it. Your daily dollar now buys less Bitcoin than before, because the price per coin has gone up. But you keep going. $1, same time, every single day. Then the excitement peaks, the chart shoots to a dramatic high. On paper, your jar's value looks fantastic. It's easy to feel invincible in a moment like this. Then, just as fast as it rose, the price collapses, hard. The glowing jar dims. Its value has fallen well below what it was worth just weeks earlier. This is the exact moment most first-time investors panic and stop. But our stickman doesn't stop. He drops in his dollar, same as always. Year two ends messier than it started. But the daily habit never broke. Year three is quieter. The wild swings settle into a long, slow grind sideways. Sideways markets are the least exciting to watch, and often the most important for building a position. While the price stays flat, your steady dollar quietly accumulates a growing pile of coins. There is no headline, grabbing chart here, just consistency, day after day after day. Then, late in the year, a small rally lifts the price just enough to catch attention again. The jar's value ticks up a little, a small reward for 3 years of patience. It's a reminder that boring periods aren't wasted time.
We make it easy to watch your savings grow.
3 years in, the daily dollar habit finally feels automatic, barely a decision anymore. 3 jars now stand side by side, each one telling a different chapter of the story. Halfway to year 10 doesn't feel so far away anymore. Let's keep moving. Year 4 starts with a jolt, a sudden sharp drop nobody saw coming. Every jar so far takes a hit in value. Even the oldest one shrinks a little. This is the hardest part of investing, watching your progress shrink and choosing to continue anyway. He drops the dollar in anyway. The price being low just means the coin bought today is bigger. Weeks pass, and the price keeps falling further. It's uncomfortable, but the habit doesn't pause. Then, almost quietly, the price finds a bottom and starts to stabilize. Because he kept buying through the entire decline, his average cost per coin has actually dropped. This is the quiet power of dollar cost averaging. Downturns aren't only painful, they're also useful. By year's end, the total coin count is higher than most people would expect from such a rough year. 4 years down, the road ahead still has plenty of twists left. Year 5 brings the biggest rally yet. The chart climbs and climbs without much pause. All 5 jars now glow brightly. On paper, this is the best the portfolio has ever looked. It's easy to imagine this growth continuing forever. History suggests it rarely does. Sure enough, the euphoria peaks and then reality sets back in. A steep correction wipes out a big chunk of the paper gains within weeks. This is the point where headlines scream about crypto being over. Again. But the daily dollar doesn't check headlines. It just keeps showing up. This up and down cycle isn't a bug in the system. It's simply how this asset behaves. By the end of year 5, the total coin count has still grown, even after the correction, halfway point behind us. This is where most quitters would have walked away. He hasn't. Year 6 settles into a slower rhythm. The wild swings of year 5 start to calm. New investors are starting to notice this space more seriously, not just as a gamble. The daily dollar routine now feels less like a leap of faith and more like brushing your teeth. Then, a fresh wave of optimism pushes the price up to a new high point. Every prior jar, even the very first one from year 1, is now worth dramatically more. This is the hidden advantage of starting early. Those first small dollars had the most time to grow. Of course, another sharp pullback follows. It always seems to, sooner or later. By now, the pattern is familiar. Rise, fall, recover, repeat, and the dollar keeps flowing regardless. The total coin pile keeps growing steadily beneath all that noise. 6 years in, the finish line is getting closer, but there is still real ground to cover. Year 7 brings something new, a long, dragging bear market that tests everyone's patience. Month after month, the price drifts lower. It's the longest stretch of red he's seen yet. Doubt creeps in. Is this still worth doing? He pauses, dollar in hand. He reminds himself, the plan was never to guess the bottom. The plan was to keep showing up. The coin drops in. Simple as that. No hesitation left. This is the least glamorous stretch of the whole 10 years and also one of the most important. Because the price is depressed for so long, the number of coins bought this year is unusually high. Toward the end of the year, the decline finally starts to slow down. The total pile of coins, though, has never stopped growing this entire time. 7 years of showing up, through the good stretches and the genuinely hard ones. Year 8 opens with a fresh recovery. Initially. The long bear market finally starts turning around. All those coins bought cheaply during the downturn now start pulling their weight. The daily dollar keeps flowing in. Business as usual, regardless of the recovering mood. The recovery gains momentum, and the chart climbs steadily for months. Every jar on the shelf, from year 1 to year 8, glows again brighter than ever before. It's tempting to think the hard years are simply behind him now. But volatility doesn't retire. A sudden sharp shock cuts the rally short mid-year. The glow dims across every jar at once, a stark reminder that this asset never sits still for long. Even now, 8 years in, the routine doesn't change. $1, same time every day. 8 years complete. 2 more to go, and the total coin pile is bigger than ever. Year 9 begins with the market, shaking off its shock and climbing back once more. By now, the number of coins collected across 9 jars is genuinely substantial. 9 years of daily dollars adds up to roughly 3,285 separate purchases, each one bought at a different price, spreading the risk across nearly a decade of ups and downs. A brief pullback arrives mid-year, but it barely registers compared to earlier shocks. 9 years of practice has clearly changed how he reacts to volatility altogether. The price steadies again, and the jars settle into a comfortable, confident glow. There is just 1 year left. The finish line is finally visible on the horizon. He drops in the final coin of year 9, almost without thinking about it. 9 years down, 1 year stands between him and the end of this experiment. Year 10, the final lap of the experiment finally begins. True to form, the market doesn't make the final year boring a sharp rally. Kicks things off. All 10 jars now blaze with a bright glow, the strongest they've ever looked. True to the pattern we've seen all along, A correction follows not long after. By now, this rhythm is second nature. Rise, pull back, rise again. He barely blinks. 10 years of daily dollars means roughly 3,650 separate purchases in total. 10 distinct jars now sit together. 10 different years, 10 different market moods. It's the final week. The habit that started as one tiny coin is about to complete a decade. He drops in the very last dollar. Day 3,650. 10 years, 10 jars. One simple habit that never once required a lump sum or perfect timing. So what's the real takeaway from this 10-year hypothetical journey? First, small consistent amounts add up far more than most people expect over long stretches of time. Second, dollar cost averaging doesn't remove volatility, but it does spread your risk across time. Third, the hardest part was never the math. It was staying calm enough to keep buying during the scary years. Remember, this entire journey was a hypothetical example, not a promise of what Bitcoin will do next. Bitcoin remains a highly volatile, speculative asset, and past patterns never guarantee future results. This video is for education. Only always think carefully and do your own research before investing anything. If this journey through 10 years of ups and downs taught you something, that $1 was well spent. See you in the next one.